An interesting budget, I thought. Well, then I would, wouldn't I? Britain is walking tall again. Now, I know the song is not quite right because it's Walk Like a Man, but I sort of was envisaging the Chancellor with David Cameron next to him, Clegg and Alexander standing up and doing a Four Tops number, or sorry, Four Seasons number, whatever it was. Britain is walking tall. As is traditional, I'm not going to go through all the macro stuff here because it's all very boring. Of course, we're all feeling much better than we did 5 years ago, of course. You know, everyone's better off, you know, the deficit's down, all the rest of it. That's all very interesting, but it's not pounds in your pocket. We're here to talk about pounds in your pocket. I'm afraid that this budget was very political. There were talk about people having two kitchens. There were talk about the opposition doing deeds of variation, and it was all very interesting. It was all a bit slapstick. But a lot of this is only going to come in if and when the government looks something like it does in 50 days' time, like it does now. So we have to be slightly careful about this. That's not to say that this won't come in anyway, but of course no one's going to commit to anything at the moment. So I'll try and distinguish between what is absolutely going to come in next year and what may or may not come in the future as we go through. What will come in, that's absolutely sure, is an increase in the personal allowance. Now, very interestingly, this morning I heard the Chancellor saying if it was only the Conservatives, the personal allowance would be £12,500. So apparently the Conservatives are now being pulled back by the Liberal Democrats, who of course his policy was to bring the personal allowance up to £10,000 in the first place. But anyway, it's just the way things are, I guess, with the election coming. And I'm not going to mention the election too many more times because I'm bored by it already. I don't know about you. But there you go, that's the projected personal allowances going forward. The result of that is that the age-related personal allowances, which have been frozen for a long time, will become redundant in the year after the next one, because the personal allowance will simply be larger than the age-rated allowance. So it simply becomes redundant. And in fact, for those born pre-48 but not pre-38, it's effectively already redundant in the next tax year. So a bit of tax simplification, no doubt someone will claim. We all know, because it's been that way for a while, I think 2011, sorry, not this completely different slide, I've changed my slide order. What we have for the first time in the next year is we have a transferable personal allowance. Now, we've been here before, we used to have this. When we first started self-assessment and husband and wives could be taxed as individuals, there was such thing as a transferable personal allowance. But in those days, you were allowed to transfer it regardless of your tax rates. And the idea was to, if you had a spouse that didn't have any taxable income, it could be transferred to the person who had taxable income to try and ameliorate the effects of going from the position before where basically husbands and wives' incomes were added together and they were taxed almost as one, well, they were taxed as one person at one point, unless you made an election otherwise. Here, there is part of the personal allowance, £1,050, that can be transferred between spouses, but the person receiving it effectively can only be a basic rate taxpayer. So, Peter, you scoff. Well, exactly. It's not a great deal of use to probably people in this room. But clearly, if you have a spouse that doesn't have any income, it's a way of transferring. I say spouse, I mean civil partner as well, and all the rest of it. It's a way of transferring an allowance worth just under £200, I guess, or just around about £200 from one person to another. So I suppose it makes a small difference for some people. You have to do that by an election. You can do that on your tax return. We both have to make it. Or you can make a paper election, in which case it stays in place until such time as you revoke it. But of course, it only has effect if you are basic rate taxpayer. Top rate tax, 45%. Now, of course, I suspect that depends on the shade of the government in 48 days' time. We have had in the recent past, tax rate changes during a tax year. If you remember, capital gains tax was reduced to 18% a few years back. and then they increased it partway through the tax year to 28%. I think that's more difficult with income tax, because at least with capital gains tax, there's sort of almost like a tax point. There is a transaction and it will fall one side or other of the tax line. I can't see it very easy to change income tax midway through the year, because there are a lot of people, self-employed people for example, whose income is in effect averaged over a year. If you're an employee, it's slightly different. There is almost a point, there is a point when you become liable to the tax, when you're paid, when it's due. But for a self-employed person, that's far more difficult. So I think it's very difficult for, no matter what the shade of government, for the rate to change during the next tax year. I'm not saying it's impossible, because they can do it and we'll all have to suffer the consequence, but I think it's very unlikely. So I think probably 45% top rate for next year. Income tax bands. Well, there they are. There's a matter of fact. What's actually been happening is that we have this system now where once you have more than £150,000, you don't have a personal allowance, and that's what's described on the next screen. And what basically happens is you've got your personal allowance, and you've got a basic rate tax band, then you've got the 40% tax band, then above 150 you've got the 45% tax band. And the 40% tax band is just simply an arithmetical difference between one and the other. And what's been happening is the personal allowance has been going up, but the rate at which you pay the 40% tax has not been going up. What the government has said is that they plan to put that up by inflation from now on. Of course, it depends on what the government's going to be. But what's actually happened, as you will see in the current year, or rather next year, it's actually come down. The personal allowance has gone up, but the higher rate band has effectively reduced a bit. So I mean, it's just an arithmetical thing. And there we are. So as I said before, you have this issue about losing your personal allowance once you have £100,000 worth of income. The 60% effective tax band, which is what it is, now applies between £100,000 and £121,600. £21,600 being exactly twice the basic rate, the personal allowance. Savings rate, this is not new, this came in last year. There is a band immediately sitting above the personal allowance for last year of 0% for savings. But that's not what the Chancellor announced yesterday. That is simply part of the picture I'm about to tell you. That came in last year. What we have now, in addition to that, is an exemption for investment income of up to £1,000 for a basic rate taxpayer and £500 for a higher rate taxpayer. None if you're in the 45% band. So we have this rather complicated position where potentially, if you are a basic rate taxpayer with very low income, you could have £2,000 worth of investment income which wouldn't be taxed. If you're a higher rate taxpayer, it's only ever going to be 500 because you lose that zero rate band as you go through, as your income goes up. The net effect of all this, when it comes in, and it hasn't come in yet, is that there will be no deduction of tax at source by banks on interest, because the vast majority of tax deducted at source is for small amounts of money. If you have large amounts on deposit, there is no deduction at tax at source anyway. So basically for wealthy people with lots of money in the bank, they never really had much deduction on their current account or something, whatever it might be. But that's not what it was after. It was about simplifying the tax system so tax returns didn't have to be issued to everybody. And because of this change, there won't be any deduction at tax at source. There will, of course, still be notional tax on dividends, which is the other part of this. And I don't think the government is going to start repaying notional tax on dividends, because that's never been repayable. It's only ever been a tax credit. It's never been repayable. So if instead of bank interest you have dividend income, which wasn't going to be taxed in the basic rate band anyway, actually, to be honest, it makes no odds. So I'm not quite sure why they're doing it, but that's the headline anyway. It's to encourage savings. Boring stuff now, and then we'll come on back onto more interesting stuff. National insurance, no change in the basic rates. The thresholds have gone up a bit by inflation. You know, this is all announced before, so no real change there. No real change in the main rates for employers, 13.8%, steady as she goes. Employment tax, of course, that being called now these days. For employees, it's basically unlimited 2%, 12% during the... So there's basically no change in all of that. And there is no change because there's been no change in the rates of income tax. There's no change in the effective rates of tax on dividends. And as we know, in the basic rate tax band, there is no additional tax paid on dividends, which is the point I was making about the savings income. Within the higher rate tax band, which is a notional 32.5% rate of tax, the effective rate is 25% on the amount of cash you receive. And within the additional rate, the 45% effective band, it's 30.55% is the effective rate of tax you pay on the cash you receive as a dividend. So there's no change on that. But what there has been, of course, as we'll come on to in a moment, is we now have in next year we have a 20% corporation tax rate flat across all types of companies, unless you're in the petroleum business, in which case it's slightly different, but assuming you are not, we have a 20% rate, which means that in the past I've had to produce a whole load of slides depending on the size of your company to work out or to demonstrate to you that dividends are better than salary. We only need one slide now because all companies are the same in effect. And this slide simply compares if you had, for example, £1,000 profit before tax in your company, how much would that cost in total tax take, corporation tax and national insurance and income tax to get that money out. And it describes, the slide describes absolutely that dividends are always better. In other words, the rate of tax, the all-in tax rate is always, well, significantly lower, I have to say, in all ways. You have to temper that with a note of caution, of course, because there are reasons why people might want to have salary rather than dividends, pension entitlement, ability to make pension contributions, perhaps even in some cases to borrow, although banks should understand that this is proper planning. There are other reasons why people may want to take salary rather than dividend, but if you can do it, then dividends is usually the best way to go. Class 2 simplification. I got a letter just the other month telling me that I would no longer have to pay my stamp. The stamp being the Class 2 national insurance. I'm self-employed. It's debited to I don't actually have to get a stamp anymore. I used to apparently have to go to the post office and get a stamp and stick it in, lick it with the back of your tongue and stick it in a book, but we don't have to do that anymore. We used to pay it by direct debit. I will no longer have to pay the stamp. Instead, I'll have to pay it with my tax bill under self-assessment each year, and that will start very soon. In fact, it's coming up, I think in June they're taking my last direct debit, something like that. Mikey, you're looking for quizzical. Did you not get the letter? National insurance, and anyone not claiming the £2,000 deduction? Anyone? We've all done it, of course, automatically. If we've done your payroll, so everyone's getting this £2,000 subsidy. It's being extended to carers. So basically, if you run a domestic payroll now, domestic payrolls were exempted from this bonus, but a lot of carers are employed in the domestic setting. People pay them, and they were excluded from this break. So they've now been included this year. So that's, I think, a welcome extension. And employers' national insurance abolished for under 21-year-olds, which is, I think, where unemployment is at the highest levels at the moment, that sort of age group. I mean, graduate unemployment's pretty bad as well, but for under 21s, apparently it's at the worst possible level. So an encouragement for you to take on apprentices who will be exempted from next year, not this coming year. All apprentices will be exempted from employers' national insurance, but for under 21s, it's for 15, 16, they're exempt from employers' national insurance. National minimum wage up 20p from October. No great surprise there. It went up by 20p last year as well. And it was still roughly 3%, so I didn't have to change the slide. At some point, I no doubt will have to. Childcare allowances were announced last year, so this is not new, but they're coming in, I assume they're coming in this year, and they're going to be legislated for now anyway. And that is basically 20% of cost up to £10,000 per annum per child. So again, that's not new. That was the last year's announcement. A lot of this was announced before or in the autumn and is now just simply coming through. So that's welcome, I think, for those with children. For those of you, and I'm looking around the room, not too many, I don't think, pay the remittance charge. Now, the remittance charge is a tax on non-domiciled persons who claim to be, who don't pay tax in the UK on their worldwide income. There are only just under 5,000 people in the whole country that actually pay this tax. And it gets a completely unwarranted amount of publicity. You know, it's people like Abramovich, good people like that, that back proper football clubs that we're talking about here. So I don't see really why he should pay. I think he should be exempt, but anyway, never mind. The remittance charge is going up. When it came in, there was this period of grace for the first 7 years, then basically you were on 50,000 forever and a day. For the first 7 years, it's going to remain in effect free. And thereafter it's going up to 60 and then to £90,000. Now, if you're very wealthy, of course, this is a drop in the ocean to you. This is not something to worry about. But a lot of people, I suspect, out of the 5,000 are going to start dropping this or just simply disappearing back where they came from, which I don't think is particularly healthy. This is a political tax. This is not a real, this doesn't really raise money. So it'll be interesting to see what happens with it. There's certainly logicality about this, but that's only for tax people. I won't go into it. Corporation tax rates, 20%. Very straightforward. Will they stay like that? We have the lowest mainstream corporation tax rate in the G7, in the Western world. The rate in the US, for example, is 40%. So it sort of just shows you where we are. Of course, when you add personal tax to it, of course, it becomes slightly different. But we have the lowest rate of large industrial countries, and that's how the rates have moved. They've come down from 28%, where we simply weren't competitive, to where we are today. So a fair change over that period. Capital allowances, no real change. What the Chancellor did do, we know we have this annual investment allowance, so this is £500,000. It went up, I guess, about 15 months ago to this level. In fact, exactly 15 months ago to this level. What the Chancellor announced is that it will not go down, assuming that he's in government, of course, back to £25,000 on the 1st of January 16, which is what it would have done, because the £500,000 is a temporary increase in the limit. It was due to go back to 25. He said it won't go down to that level, but he doesn't know what level it will go down to. So clearly, if you're thinking about capital investment, you need to think very carefully about the timing of it, because one ought to at least think about using up the band. If you're going to be over it, you need to think about the timing of your investment and think very carefully about it. You need to be careful with year ends and all those kind of nice things. I have no doubt at all, if there is a change of government, there will be a budget in July. if not June. Well, probably June, because of course it's holiday time, isn't it, in July? They'll all be off on their summer holidays. So probably in June there'll be a budget. We may or may not decide to reconvene and give you another breakfast. That's not exactly budgeting, is it? Especially when we have to import special jam for Peter. I've no doubt there will be another budget if there is a change in government. But anyway, small change to R&D credits for those of you, the increasing number of people that claim them. They are actually much easier than they used to be to claim. I don't know why. I think it's because the government wants you to have them, I think is the basic idea. Perhaps there is some kind of statistic that they are happy to play on with their tax credits to say we are the sort of country that invests in this kind of thing, and that's all very good. A slight increase in the rate for small and medium enterprises. But there is also what they call the Advanced Assurance Scheme going to be introduced. Now, because it is now so easy to get it, I'm not really quite sure why you need it. I don't think anyone would probably, unless we're talking about absolutely vast fortunes being involved, decide whether or not to embark on a R&D project because they're going to get tax credits. They embark on R&D because they think it's going to be good for their business and they need to do it, not because they're going to get a tax credit. A tax credit's a bonus. But there's all kinds of things you can get R&D for, and it's worth just having a think about whether some of the things that you do, which may be just ordinary everyday things to you, but which are trying to develop new products, could be R&D, because you can get, as I say, increased tax relief for it, so it's worth the real money. Multinational enterprises, the so-called diverted profit tax. Going to be very interesting to see how this works in practice, because it's obviously what it's aimed at is clear to see. It's obviously aimed at companies that do vast amounts of turnover in the UK but pay very, very little profits tax for one reason or another. Now, historically, of course, that's probably for very legitimate reasons, because they've got very expensive and worthwhile brands that they're paying vast royalties on to Liechtenstein or Switzerland or somewhere else where these brands are properly owned from. But of course, to be honest, the government could have always tackled that. They didn't need a profits tax to do that. They could have looked at the rate at which those royalties have been paid and say that's too much, and just say you can't pay that much. So why they quite need to do this, I don't know. But for aggressive tax planning, apparently, whatever that means, and I don't know what it means, because to be honest, what most of these corporations are doing, I would have said, is just normal stuff for business. There's going to be a 25% rate, so it's more expensive than corporation tax, which seems odd to me. I would have said corporation tax and bung a penalty on it, fine, but to have a different rate seems odd. So how much tax they're going to collect from this, dubious, I would say. I think some companies have already changed their practice anyway to pay what they think is a reasonable amount of tax. So there's going to be big arguments over this. And of course, it could be anti-European. I can see an argument here about it being a breach of human rights, breach of free movement of capital, all kinds of things coming up. So it's going to be very interesting to see how that actually applies in practice. But it's good political stuff, isn't it? Capital gains tax. Annual exempt amount up £100 to £11,100 from 11. The rates of tax are the same, 18 and 28. We talked about how it was 18% because 18% is apparently okay. 28% is apparently the break point at which people don't want to pay tax. I don't want to pay tax at 28%, I don't know about anyone else, but apparently scientifically 28% is the rate at which people balk at paying tax. So that's why it's there. And we still have the entrepreneurs' relief £10 million limit. Now, entrepreneurs' relief was very interesting when it was introduced because there were never any anti-avoidance provisions in entrepreneurs' relief. It was a very, very simple relief. There were some simple qualifying conditions and you either got the relief or you didn't. and there was no, as I say, no anti-avoidance provisions. But apparently people have been using it for nefarious purposes, for paying tax at a lower rate than they should have been. So we're beginning to get some anti-avoidance stuff come in. This first lot came in with the autumn statement, and basically there was a jolly good wheeze, and I'm afraid that we advised clients to do it when it was appropriate to them. If you started business as an unincorporated business and then incorporated your business, obviously this is only for new businesses, then you were able to effectively sell your business to your company and create a balance which you could be paid over time at 10%. There's nothing particularly controversial about that. You've always been able, in effect, to do that. The controversial thing was the 10% rate of tax, not the fact that it was capital gains tax. And the government said, no, we don't like that. If you own the company afterwards and you owned the business before, no, you can't have entrepreneurship relief. Okay, fair enough. So I can see the logic behind that, because in effect, commercially, you're the same before and after. So yeah, fair enough. They have pulled that back a bit because they realised that some people may not be in the company, but were in the partnership. And for those that don't carry over, they can actually claim entrepreneurs relief now. So that's a bit of a loosening that came yesterday. And that's perfectly reasonable when you think about it. If someone's leaving, well, why not? They should take their money. The flip side of all that, and the reason why it was so good, of course, before, was that companies, when they acquire goodwill, can write that off against tax. I mean, there are some limits, but generally they can write off depreciation of goodwill against corporation tax bills. And they were able to do that when the business was acquired from a connected person, and you can't do that anymore. So from last December, you can't do that. So that sort of squared that circle. So that really changes the way that we think very often now about incorporating businesses. And there are a couple other restrictions about I'm about to explain. On the flip side, there was always another problem where you would sell your business and then realise a gain and then defer it potentially into assets which then qualify for some other kind of relief, EIS relief, for example. And the problem was always that if you did that, you weren't going to be entitled to entrepreneurs relief, because the nature of your asset had changed. It had changed from being an asset which might have qualified to one that didn't. And the government's basically saying, well, okay, we realise that's a disincentive. So if you sell shares that qualified for entrepreneurs relief, and then you roll over, in effect, those gains into an EIS company, you can take that qualification for entrepreneurs relief forward into your new investment and you don't lose it. So you don't have the silly situation where you could have had 10%, and because you've rolled over and done something the government wants you to do, to invest in a company that needs money, that you then have to pay 28% on the way out. So all very sensible. And that came in the autumn statement. This is where people have been a bit naughty. There was a concept, or there is a concept, and this used to apply with the old retirement relief as well, that where you come to retire from your business, which is what retirement relief is about, entrepreneurs relief is not actually about retirement, but that was the basic fundamental for it. It's about disposing of a business and coming out of it. But you don't actually have to come out of a business under entrepreneurs relief. So the idea was that sometimes you own, for example, shares in a company, or you are a participator in a partnership, and you make a disposal in the partnership, but at the same time you have an asset, usually a property, which the partnership or the company has been using for the purposes of its trade. And the associated disposal rule allowed, assuming you didn't charge a full rent and various other things, you to get entrepreneurs relief on the side of the property that was used by the business. And of course, because there has to be a connection between the associated disposal and a disposal of a part of the business, what people were doing was they were, in a perhaps opportunistic way, selling the property and disposing of maybe one share in their business to somebody else. So they qualified for entrepreneurs relief. And what the government said, well, that's just not good enough. That's just not the idea of this. You've got to make a proper disposal of part of your business to a third party. So they're saying you've got to sell at least 5% of the shares or the business at the same time as you make the associated disposal. In fact, very few associated disposals ever qualify for entrepreneurs relief because most people want to get a full rent for their property from their business. If you do that, you don't get entrepreneurs relief. So basically you'd have to rent the property to the business for no rent or a low rent in order to get the associated disposal entrepreneurs relief. So it's actually fairly limited, but you could see people were obviously setting this up as some kind of a tax scheme. There was also apparently situations where people were putting money into holding entities that were then investing in trading companies. And the government has said that where the company that's invested in has no trade of its own, but it simply invests in others. And by that they don't mean 100% holding company of a trading company. They mean a company which has a series of small investments in other trading entities. Then you can't get entrepreneurs relief. They don't like it. It's not what it's about. So if you have that structure, you need to look at it. Residential property. There's a typo on the slide, so I will tell you what it means. Basically, non-residents didn't used to pay tax on property or other assets in the UK. With effect from this 6th of April, UK residential property is now taxable regardless of where you reside, which is a change in our capital gains tax rules. If you are a non-resident and you own an existing property, you can effectively rebase your property to current value. The government's notes make it very clear that the person is responsible for getting their own valuation and it being right and all the rest of it, just as we all are. But in essence, it's only gains from 6th of April that will fall into this new tax charge. No withholding at source, which does apply in lots of other jurisdictions. That would be too difficult and it's anti-British. So it will be self-assessment. We'll come on to self-assessment in a while because apparently it's going to be abolished. You know, that's going to make things a bit more complicated for non-resident persons, but probably fair enough. Doesn't apply to commercial property, by the way, only applies to residential. Doesn't apply to commercial property because nobody makes any money on it. Inheritance tax, no change in the rates at all. There was talk about an increase, I think, before the budget of taking up to £1 million for a couple, but that didn't come in. As we know, because the nil rate band is transferable between spouses and civil partners, in effect it means there's a joint £650,000 IHT exemption, which will buy you a shed in the back of a garden around here. So, you know, it's fairly limited, depending on where you live. This is very political. The government is going to consult, apparently in the autumn, on whether deeds of variation are a good thing. They have done this several times before over the last 30 years that I've been in tax, and they've always come back to the concept, actually, it's not that deeds of variation are a problem, it's people abusing them, which is the problem. Of course, this came up purely because the Miliband's did exactly this with their parents' estate. Which is why it came up in the budget and why we're going through it. But chances are that I suspect they won't do anything about it because what it does is it protects people that have poor advice or can't afford to get proper wills or don't have wills. That's what this is primarily aimed at protecting. The people that use it for tax planning are usually those that are not the people that have died that are doing the tax planning. Of course, it's the people that survive that do the tax planning that want to do it slightly differently. So I suspect this will go nowhere, but another consultation. SDLT. This was the major revamp in the autumn statement. I'm sure everyone's familiar with it. This is the non-residential, the commercial, no change to that rate, maximum rate of 5%. The big change, of course, was on residential properties, where we now have a progressive tax, I think that's what you would call it, where rather than having one rate which applies across the entire consideration you pay, as you go up through the bands, you simply pay the additional tax in each band. So we now have a 12% band and a 10% band and a 5% band instead of what we had before, which I think was up to 7%. So I didn't bother working out what the break-even was because I have a more interesting life than that. At least I hope I do. But clearly, when properties are just over the £1 million mark, it's becoming more expensive to move. 8-head, annual tax on enveloped dwellings, is now becoming more and more in point. What this basically applies to is residential property inside a company or a trust or some vehicle, in other words, not owned by individuals. And it affects stamp duty, land tax, capital gains tax, and there is an annual tax on the property, which we'll have a look at in a moment because it's quite severe. It doesn't apply if you're a trader, so it's a major, so if you're a property developer or something, it doesn't apply. Basically, it only applies where you have a property in a company and you or somebody connected with you occupies it in some way, shape or form, even if for full rent. That's when it bites, and it can be quite vicious. So what it does is it puts up the stamp duty rate to 15% flat, okay, from property worth over £500,000. So if you were to buy, while you do this now, you wouldn't do it. If you were to buy, for example, into a company, a house for your elderly mother, and it costs just over £500,000, you're paying 15% stamp duty on that rather than the ordinary rates. You just wouldn't do it. I mean, clearly you just wouldn't do it, but and you'd find some other way of getting the money out of your corporate structure in order to do that, to avoid paying this tax. But that's what it means in effect. This is what the annual charge looks like. Okay, if you are subject to 8-head, you have this penal tax. It's like a form of mansion tax, if you like, and you can see it's not insignificant. It's something below 7%, between 3.5% and 7%, and it's a fairly decent amount of money, even if you own a house of £20 million. To pay £218,000 as a one-off tax to the government is a reasonable amount of money. It makes rates look a bit silly, doesn't it? Because you're probably paying about, well, in Westminster, you're probably paying £500 a year rates or something. But you're paying £218,000 in this one-off charge, one-off annual charge to the government. So it's a large amount of money. You'll notice that for the next year, it starts at £1 million, but from the year after, it'll start at £500,000, and the rate is 3.5% is what they've announced. It'll probably go up by inflation because they said it will go up by inflation. But so for even the £500,000 property, you're going to be paying this annual charge. And of course, any company, I didn't put it on the slides, but any company that's subject to 8-head pays capital gains tax on the property which is subject to the charge. The reason I say that, of course, is because a lot of the companies that are within the charge to 8-head are overseas companies, and they generally are without the charge to tax in the UK on capital assets. So they are caught, just as individuals are now caught, offshore companies are now caught on these kind of properties. Value added tax, 20%. It's been that way for a while. No sign of it coming down. Registration limits went up by £1,000. No great surprise there. Just a few words about tax avoidance and stuff like that. We've now had what they call the GAR, the General Anti-Avoidance Rule, for a little over 2 years. We have not seen a case yet, or at least I haven't seen any publicised either, that have come under the GAR rule. The GAR rule is a very fluffy thing. It just has no substance. It has a committee which meets that says these things are bad, but everybody knows they're bad, so that's really not a surprise. But the idea is that if they are said to be bad, the government has a way of saying, you know, these things are bad and throwing a stick at you, and you're not supposed to do it, and of course you get a penalty if you do it and all the rest of it. It doesn't mean they're not perfectly legal. It doesn't mean they don't work. It's only somebody's opinion. It's a very, very difficult thing to apply in practice. And when you go to council and you talk about schemes, some of them will say, well, that's a joke. It can't possibly ever apply to you because there's no proper mechanism to enforce it. Others are very wary of it. But the fact is we haven't actually seen any of it yet, and it's now nearly 2 years into it. So we haven't actually seen the formal side of it, but of course tax avoidance is morally reprehensible, as we all know. And we will come on to what the government are doing about it in a moment. ISAs. I don't normally spend a great deal of time talking about them because they're relatively small amounts of money, but there are some welcome changes, I think. You can now inherit an ISA. Well, at least a spouse can inherit an ISA, which means that if you've both built up a load of these tax privileged investments, the privileges are not lost on the death of a spouse. The ISAs can continue in the name of the survivor with the tax privileges. Tax privileges being in effect that you don't pay tax on the income. So it's a welcome change. It's not major, but it's a welcome change. The value of an ISA has now gone up to, on an annual basis, to 15,240, which is great. The individual limits within the ISAs for shares and cash were abolished last year. No change with that. That's good. But what they are going to allow is for you to dip into your ISA as long as you put the money back. Within the tax year, that's what they're basically talking about. You won't have lost your privileged status in that ISA. At the moment, if you withdraw money from an ISA, if you put the money back in, it's part of your annual contribution to the ISA, so it's part of your 15,240. But if you put the money back into an ISA because you had to borrow it temporarily, it won't be part of your annual limit. So you can still put your annual limit into a new ISA. So that's probably welcome, as people need money. But we've got this new Help to Buy ISA. I don't know why they have to call it a Help to Buy ISA, but that's what they've done. Basically, over a 4-year period, you can hold the ISA for as long as you like, but over a 4-year period, if you build up whatever you accumulate over a 4-year period, up to a limit of £12,000, the government will add £3,000 to it at the end if you go and buy a property with the money. You have to be a first-time buyer. The property limit in London is 450, so you're limited on where you can buy. Outside, I don't know where the limit is or where the geographical boundary is, but outside London it's 250. And it's basically just a first-time buyer subsidy. The idea being, presumably, that it's not even a 5% deposit, is it? At that level, it's a fairly meagre deposit, but so presumably there'll be some other schemes to get the mortgage in place, so the banks don't have to take any risk, and we take the risk as taxpayers. But that's me. I suppose it's welcome. Pensions. There was a feeling that tax relief would be taken away from the current £40,000 contribution cap. They didn't announce that. In fact, he made a point of leaving it at £40,000. If the government colour changes, I suspect that will not be the case. I suspect the £40,000 cap or tax relief on it will be impacted in some way, shape or form. What he did announce, however, was a reduction in the lifetime allowance, not from next year but from the year after, to £1 million from 1.25. That's been coming down steadily. And of course, at current annuity rates, you need an awful lot of money to have a pension. So it means that, to all practical purposes, unless we have a real period of inflation and or high interest rates, a lot of people are going to struggle to provide pensions out of this kind of pot. So they're going to have to think about alternative products. Annuity flexibility, I won't talk about, because people are, I'm sure, bored to death about the changes that are happening in pensions with effect from, you know, being able to draw your money out and all that and pay less tax. It's all very interesting stuff. But of course there are 5 million people who've already got annuities, and they weren't being allowed into the new pension flexibility rules. What the proposal is, and it does require some consultation and all the rest of it, is they're proposing that in effect those that have annuities, that have current annuities, will be able to sell them in the secondary market. So they'll be able to convert those annuities back into cash. Okay, they'll pay tax at their marginal rate on whatever they sell it for, but they'll be able to get their hands on a cash sum. Now, the government's saying, of course, you need advice to do that. There are no advisors. There is a distinct lack of people that can provide advice like this, especially really dangerous advice like this. This is a bit akin to the scandal that occurred when people were being moved from occupational to private pensions. This is a big problem. You have to stick your neck out a fair way to advise somebody to do something like this, but they're going to need advice to do it. So the government is promising something it may find it very difficult to actually deliver in practical terms. I mean, obviously you can selling the annuities simple enough to arrange, but the advice thing is going to be very difficult. Dispensations. A lot of you will have dispensations for expenses or certain types of expenses, so you don't have to fill in P11Ds for all these silly little things. For expenses of under £50,000 or under £5,000, £50 I should say, that's a ridiculous amount of money, £50, they're just going to be not reportable basically now, unless you are a director stroke shareholder of a small closely connected company, because that would be open to abuse. So if you are a non-connected, just ordinary employee of a small business, then, or in fact any large business, then small benefits are simply not going to be taxable and you don't need to report them. Expenses payments. Very often employers pay things which are then put on P11Ds and employees then claim them as deductible. So there's this whole paper trail that goes on of filling in P11Ds, employees claiming deductions, and the whole thing goes round in a circle, lots of job creation in the process, but no tax. The basic idea is that those expenses will not be reportable. If the employee could claim them as being wholly and exclusive necessarily for their employment, they don't go on the P11D. So it's a welcome, it's basically an automatic dispensation for proper business expenses, which is just sensible. I suspect it's because the revenue don't have enough people to monitor this sort of stuff anymore. They've just made it, just changed the rules. Peer-to-peer lending. There was a major problem with peer-to-peer lending. I mean, this all goes on over the internet and all that sort of stuff. And the trouble is that the way the tax system is, and it's quite deliberate, the government or the revenue authorities do not like individuals trading as loan providers. They don't like you to have a trade of providing finance. And the reason they don't like it is because if you lose money, you get to set it off against your income. Okay, there are now restrictions on, the physical amounts you can offset each year and all the rest of it. But this is obviously a real problem, because the whole way that peer-to-peer lending works is you're going to lose some of the money. That's just the way it's going to work, because it's a basket type approach. You throw a load of money out, you win some, you lose some. That's just the nature of it. And what was happening, of course, is all these people were being taxed on their profits and getting no relief at all for anything they lose, which is frankly unfair. So what they've done is that they've given a measure of relief. They're not going to allow you to offset your losses against your general income. What they are going to do is allow you to set your losses against your income from peer-to-peer lending. So you just sort of put it in a box, which is sensible. It just means that you stand to lose that capital. You can't set that capital loss against anything else, but you can at least get some measure of relief for it. So it seems sensible. It seems sensible to me anyway. It's a welcome relief. Farmers averaging, I don't know whether there are any farmers in the room, but farmers' income is very volatile. And for ages they've been able to, in effect, average their profits. So when they have a good year followed by a bad year, or a bad year followed by a good year, they sort of pay tax on half profits all the time, rather than having to pay a large amount in one year. Because of course you pay your tax in arrears. So you have a good year, then you have a really bad year, but you're paying tax on the year and all that. So it's a problem. So what they're going to allow is 5 years averaging. So you have this rolling average that you'll calculate. So you average out your tax payments and average out your income if you're a farmer. Banks, compensation payments not to be tax deductible. Hurrah, they say. The net result of that will of course be large provisions for compensation. Well, it won't be actually. I mean, basically, they're putting this now in akin to a fine. A lot of us, if we do something wrong, if you commit a driving offence, a parking offence or anything else like that, you do something you shouldn't have done, you don't get tax relief for it. But the banks, of course, were getting relief for compensation payments for mis-selling. And they won't. I don't think it's backdated, it's only future. And I suspect the horse is probably well and truly bolted by now. At least I hope it has, because otherwise there's something else to come out. But they're not going to be tax deductible in future. Offshore tax evasion. This is really getting quite serious. There will be a new ability for, and I think they will use it, for the revenue to come to people like me and say, give us the names of all your clients that have offshore bank accounts. And we will have to provide it. Now, in the past, they would have had to go to court, get a court order, and they would have to have reasonable grounds, and there would have to be reason to suspect somebody had done something, all the rest of it, but they won't anymore. And that would apply to us, it would apply to financial intermediaries. They get all this information anyway from lots of people. But, you know, of course, if we knew a client had an offshore bank account, it would be on their tax return, so it's not a problem to us, of course, but for other people it may be more of an issue. So the net is tightening. There will be new offences to do with offshore evasion, new criminal offences. I heard the Chancellor being interviewed on Radio 4 just as I was coming here about one of his government colleagues who was chairman of a bank in Switzerland that may have been subject to the new criminal sanctions, but of course he didn't respond to that. So the net is tightening, and frankly, if you do have an offshore bank account, you need to do something about it pretty damn quick. Otherwise you're going to end up in a lot of trouble. Employment intermediaries, there will be a new consultation. For years there has been a whole industry around reducing tax by converting what otherwise would be ordinary earnings into subsistence or travel payments. So certain classes of worker, they could be truck drivers, they could be security guards, this kind of stuff, but it is much wider than that as well. In effect, their taxable income was reduced by converting some of that income into payments for expenses. And they probably were legitimate expenses because people have to travel to get to work and all the rest of it, but for most of us, travel to work is not tax deductible. But you were able, through a series of devices, to make that tax deductible. They finally, and the way the tax system worked is that a lot of these people were not in the tax net before these systems were created. So the revenue sort of accepted this was a way of getting people into the tax net and taking some tax rather than none, but they've had enough now. I think they've had enough, and they're basically going to try once and for all. They've had IR35, IR30 for years and years and years, all kinds of devices, all kinds of things, and they've had, actually, I think they've now had enough. And they're going to consult on ways of basically just getting rid of the whole practice, which means an end to a whole industry. Offshore tax, I talked about offshore bank accounts. There is a series of offshore disclosure regimes, Liechtenstein being one of them, quite favourable. Whereas if you managed to get within it, you paid a sort of a guaranteed fairly low penalty, as well as interest on your disclosures. They're going to bring those to an end early. And they're going to give a final chance, a final amnesty in the next couple of years with a 30% penalty attached to it. And I think that really will be the final chance. Thereafter, I suspect if they catch anyone with offshore income or bank accounts which are not being disclosed, it will be straight to jail. And I don't think there'll be any messing. Digital tax account. The abolition of self-assessment tax returns. Okay. Well, of course, this is really very, very worrying. The government collects a lot of information about all of us. It knows what interest we get from UK banks. It knows, it takes a little while to get it, but it does know very often what income and what money we have in offshore bank accounts as well. What the government's going to do is, in effect, set up a central depository. They already have it on their own records for each of us. And the financial institutions and employers, for their payroll and all the rest of it, will send data into the revenue. And it will all be posted into this account for you. Now, the revenue already have this for you. They already see this. When you send in your self-assessment tax return, they have this information. What they're going to do is turn it into a more customer-friendly database, which you will be able to see, and you will be able to add to. And when you've finished adding to it for a year, that will in effect be your tax return, because the computer will then work it out. If that was the end of it, that would be great. What they're proposing is to allow you to connect your accounting software for your business to the government's database, so you can also input your company accounts to it, transaction by transaction. Can you imagine? Can you imagine explaining your journal entries at the end of the year to the tax inspector every year? Peter, you're looking very worried. You've gone pale. But this is where we're going. This is the frightening thing about it, is that there won't be any self-assessment tax returns. There'll just be this database in which you put all your information. Okay, well, agents will still do it for you and all the rest of it. That's a given. For most people, that's not a problem. All they have is maybe a pension, a bit of earned income, a bit of bank deposit, and that's fine, absolutely fine, no issue with that. And the government can get the right figures and correct everything. And you can see it as a taxpayer and you can complain about it. But we have the problem even now where we get information about people's state pensions come through on our software, direct from the government database, and it can be wrong. Changing it is a major problem. So they can make mistakes, and the concept of us putting our accounting records direct into the government's database is just staggering. At the moment it will be voluntary, but I can imagine it being, well, it's good for me, I suppose. It's employment for me, isn't it? Sorting it all out when it all goes wrong. But anyway, there we are. So that's, I think, a quick run through of, I think that's the end of it. Yep. That's a quick run through of the budget in 58 minutes.